Hello, welcome to this episode of Rich Insights. I'm Don Rich, Chief of Investments for Esoteric Capital Management. Today's topic is a financial iceberg. All right. Before we talk about what's going to happen in the future, though, let's talk about current events. Let's talk about what's happening today. Now, I was hoping to use today's broadcast to talk about something positive, right? Something good that's happening in the world, in the investments world. And it's really hard to come by, right? It's really hard to find something to get excited about. Now, equities are obviously down sharply today. But one way to look at it is we're really just taking back the large run-up that we had on Friday, right? Is that good news? That's about the best news I can come up with. Well, in terms of current events, we have seen overnight, we got a lot of activity data out of China. And that should give us, hopefully, some sort of a roadmap as to what we may see coming in the States. Now, unfortunately, all of that data are quite concerning. Right? We had retail sales come out. And that fell over 20% year on year. Right? So sales are down 20% from a year ago. That was the worst number in the recorded history, right? We have history for the last 30 years of retail sales. We've never seen a number that bad. Not even close. By far the worst number. All right. So obviously the quarantine is brought the economy and spending to a standstill, right, in China. So the retail sales came out. They also had industrial output. Again, the same thing. It fell 13.5%, right? It's not 20%, it's 13.5% from a year ago. But again, by far the worst in recorded history, the last 30 years. And then lastly, China published fixed spending on infrastructure. Same story. Worst number in the 30 years of data available in the data file. All right, so this is obviously concerning, right? Current events are concerning. I don't see any way that we're not going to just see a wave of earnings downgrades coming in the U.S. Right? I'd like to tell you there's good news coming. But I'm just not seeing it yet. I'm not seeing that enough people are taking this seriously enough, whether it's in their personal lives or in their investment lives. The earnings downgrades are going to come fast and furious. All right. Now that doesn't mean stocks are just going to keep going down, down, down. We're going to have a series of waves coming at us, but we do have more bad news coming. All this idea, all this talk about a V-shaped recovery is hogwash, all right? Every time I hear a V-shaped statement, I just smell, right? Smell, because I can smell bullshit, all right? That's what I'm smelling when somebody's talking about a V-shaped recovery. That's bullshit. That's just not going to happen. All right, so we got more bad news coming at us. That's not the financial iceberg I'm talking about. What's the 800-pound gorilla, right? What is the epicenter of this financial crisis going to be, right? We know what it is, and as we look back to 2008, and obviously it was a dot-com bubble in 2000. What's it going to be this time? Well, it's the corporate credit market, exactly. All right, so you got to stay with me here for a minute, right? So we have investment grade bonds and non-investment grade, right? Or high yield or junk bonds down here, all right? Now, investment grade bonds make up about 75% of all bonds outstanding, all the corporate bonds outstanding, right? 25% is junk. All right. So in this investment grade, we have AAA is the highest rated, right? Those bonds that have the least default risk, the lowest credit risk, the AAA bonds. We have two companies in the U.S. with AAA rating, Microsoft and Johnson & Johnson. All right. You've seen in previous segments, we talked about this many times before. We used to have a ton of AAA firms. Today we have two. All right. So again, in the investment grade section, we have four categories. We have the AAAs, the AAs, the single A's, and the triple B's, right? The triple B's are the lowest investment grade level. Now, over half of all investment grade bonds fall in the triple B category. All right, over half. So again, all of investment grade is 75%, high yield is 25%. Half of this 75% is triple B's. All right, over half. So what's half of 75? Well, it's over half. So let's call 40% of the bond market is triple B. It's on the lowest level of investment grade. So 40% of the bond market, roughly, again, back of the envelope numbers here, but 40% of the bond market is triple B, just above being downgraded to junk, right? Now, when those corporations that are too highly levered, right? That's how they got there in the first place. They're triple B because they've taken on more and more leverage the last few years. This problem's been brewing for a long time. Now we got, again, 40% of the bond market that's in this risky scenario. So these firms have taken on more and more leverage, and now we're going to start seeing some of them downgraded. And when that snowball starts going down the hill, well, you know what happens, right? That snowball turns into a snowman, which turns into something bigger and badder. So just think about it again, 40% of the market being triple B, and the whole junk market is only 25% of the market. All right. So when this thing starts, when the downgrades start, right? To borrow one of the expressions of my father, we are talking about putting 10 pounds of sugar in a 5-pound sack here, all right? This isn't going to happen easily. We are going to see massive liquidity dislocations. All right, what do I mean by that? Well, a number of the bond managers in the world can only hold investment grade bonds. They can't even play down here in the high yield section. So when a firm's downgraded, they have to sell it. They don't have a choice. They have to sell it. They only have a matter of days before they have to be out of their positions. All right. And of course, all investment grade bond managers in the same position, they're all selling. So not only do you get the bad news that you've been downgraded, but then you get the forced selling that accompanies that. Now, obviously, when you go into high yield or the junk category, then these corporations have to pay a higher rate of interest on their debt because they're deemed to be less creditworthy. All right, so their cost of capital goes up. And again, there's less and less money in these high yield in this high yield bond sector. All right, so the supply of high yield bonds is going to go up tremendously, and if the demand doesn't change, well, we don't need a PhD in economics to say if we get a huge increase in supply and demand doesn't change, what do you think is going to happen to price? All right, well, you don't have to stop by a Mensa meeting to figure that one out. That's not good. That's the financial iceberg we got coming at us this time. Now, unfortunately, the government can't bail everybody out. That's impossible, right? The old phrase, right? We're supposed to love all our children equally. Well, that's horseshit. We all know that's horseshit, right? Now, the government's going to have to decide who they want to save and who they don't. Right? Stop and think. Are we going to save the oil producers, for instance? What about the travel industry? Let's take the airlines. Are we going to save the airlines? What about, I don't know, entertainment? We're going to save the casinos? Or retail? We're going to save the restaurants? Professional sporting events? The theaters? What about Broadway? All of these firms are going to be in dire straits here in a very short period of time. And obviously, you can't save everybody. So when they're not being saved, these investment grade companies are going to be downgraded. Now, again, the thick layer of triple B bonds that I'm talking about, the 40% of the bond market is triple B and at risk of being downgraded. What's in there? Well, for the most part, it's the old industrial firms. I'm not going to mention any names specifically, but they're the companies that you're used to. All right, all industrial America fits in that category. Some of these firms are likely going to be downgraded to the high yield status, right? And that is going to present a tremendous liquidity problem when it happens. Again, it's not going to happen today or tomorrow. We're talking a few months out, but it's not likely to be very many months out either. So keep your eye open for that. That's something that's coming down the pike here. We're going to see it. We're going to see it for sure, for sure. All right. That's our message for today. You've just experienced a Rich Insight. I'm Don Rich. I hope you enjoyed it. Thank you.